Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 424. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
Oh, we're actually going to talk about life insurance today?
We're going to do that.
Oh,
we take
right.
breaks. We get people kind of excited. They got to sit at the edge of their seat going, is it going to be about life insurance today? It's going to be something about something else. That's the excitement of what we do.
That is. If that's the excitement, then
keep them on their toes. I'm told that's a winning strategy.
That's right. Sounds like it. I don't have a follow-up for that. I mean, you sound like my first sales manager. So there you go.
There you go. It's because it's a beautiful statement. So today's about life insurance, specifically how maybe, but why definitely it works to give your money to a life insurance company and expect that it will grow into something much larger.
Yeah. Contrary to popular belief.
Yep.
The financial gurus on the internet would have you believe that it's just an absolute ripoff. And I don't know.
It's where your money goes to die.
Yeah. I don't know what they think life insurance companies do with the money exactly, but pay agents. That's what they.
Yeah. Pay agents to go on trips.
Brandon, let me ask you.
Yep.
Since you brought it up, how many trips have you been on?
0.
Yeah, me too.
First, I'm a New Englander.
Someone's going to be smart and go, how many trips have you earned? Several.
Yeah. I'm a New Englander, so my love of hot and humid places is moderate at best.
That's right. And they always seem to be in hot and humid places. That's a good observation.
Yep. And my desire to do that with a bunch of old dudes is even less. So, But we like the old dudes who listen to us, so welcome and thanks.
Yeah, absolutely.
We would hang out with you, but
if they would just give us the cash that they claim to pay for these trips, then
they would be okay.
That'd be fine.
True. This is true.
We've been making that point for years.
Mm-hmm. So, contrary to popular belief, life insurance companies are themselves asset managers.
Yep.
They are.
Mm-hmm.
And
that's why private equity is so interested in them.
Yep.
In the last few years.
As asset managers, I think when we use that term, that conjures up a certain idea about what they must be doing then. But that's not usually correct in terms of what you're probably thinking.
Mm-hmm.
Because asset managers in the context of a life insurance company is all about taking the dollars they collect and investing it in a way that is going to grow that to a balance that is capable of covering the liability they are committing to.
Right.
So when you
the underwriting serves as the spread in between, basically.
Yep. Correct.
They know that certain people are going to die long before the assets exist and I'm just talking about one singular policy. I'm not talking about as a whole. But their goal is to actuarially come out ahead.
Yes. Yes.
And
by categorizing the applicants.
Otherwise, they won't be around to pay your death benefit. So,
yeah. Yep. So if you think about this, when a life insurance contract gets issued,
mm-hmm.
you are giving the insurance company a few dollars. They're promising a whole lot more if you die.
Yes.
And there are ways to manage that contract, that obligation. And in the pursuit of that, one of the key features is we're going to have to take the dollars that we ask you to give us, and we're going to have to figure out a way to grow those dollars to back this liability that we have outstanding, especially by the time we predict it's going to come due.
Right.
So
exactly.
They are intently focused on taking those dollars and growing them in a way that is significant, but also in a way that keeps an eye on safety. Because it is of zero value to the insurance company to take your dollars and buy GameStop calls with it and lose it and then go, hopefully Fred doesn't die.
Yeah. That's the sort of things that gets them shut down.
Yes. Yes, it does. And in big, big trouble if they ever did it. By the way, insurance companies don't do that.
Right.
But I want to point out and drive home the fact that they are, in fact, taking the money and very explicitly focusing on growing the value of that money so that they can cover the liability that they are now committed to.
Mm-hmm.
And this process and the need to build a pot of money to back the liability is most perfectly expressed when we look at cash value forms of life insurance. I'm not saying it doesn't exist with term insurance. It does. It especially exists with level term insurance.
Yeah.
But there's an adjustment to how they view the probability of ever needing to pay that claim, which is pretty small.
Right.
But cash value life insurance comes with the very real threat that this policy will exist when the person dies.
Is that what they call it? Permanent?
Yeah.
There you go.
That's why they call it. I voted for threat level high life insurance, but nobody liked that.
DEFCON 1. Yeah. Wasn't very popular in the focus group.
Nope. So when we look at cash value forms of life insurance, the premiums are understandably much, much higher per unit of death benefit
right,
than would exist for term insurance, because the insurance company needs more money to build the cash cushion they're going to need, given the fact that there is a substantially higher probability that they're going to pay a claim on this policy.
Right. Yep.
So
exactly.
This is what insurers are doing. So think about this in the context of, I go out and I buy $1 million whole life policy. The insurance company is going to ask for money every year in order to make that a reality. And they are asking for a sufficient amount of money to basically give them the capability of a cash position some years into the future that will be $1 million.
Right.
And if you make it to that point, they'll even give you the $1 million.
Yep.
And if you don't, they'll still give your beneficiary $1 million.
Funny how that works.
Yep. Now, here's where things get really, really interesting. You can give the insurance company more money than they ask for.
What?
Yep.
Why would you do that?
Because you're dumb. That's what some of the internet would have you believe.
Okay. I was going to say, well, our whole practice is built on that concept. So
we hold a different view on that, but that's what several people who have never sold life insurance or could pass an insurance exam would tell you. But anyway, you can give the company more money. And when you give them more money, they will take it and they will do with it exactly what they were planning to do with the money they asked for.
Mm-hmm.
In fact, insurance companies don't have a mechanism to differentiate those dollars.
You mean they don't go, well, this is extra premium, so we're going to do different things with the money?
Right. No, they don't. They don't take your extra dollars and go, it's not that important, so we'll put that in 3-month treasuries.
Right.
That's not how that works. They are going to invest your extra dollars with the same spirit they were investing the required dollars.
Yep.
Which means everything they set out to do to grow that money is applicable to the money they ask for and the money they don't ask for.
Right. And functionally speaking, I mean, we can tell you how this happens or how it manifests. And in a whole life policy, extra dollars would typically be money going to paid up additions.
Yep.
Some people call it different. I think we've talked about that before. Different companies call it different things, but it's effectively paid up additions. That's typically how that works. In an index universal life policy, which is other permanent policy we talk about a lot, it is, what's the best way to explain it, Brandon?
We call it excess premium.
It's excess premium. Yeah. Extra, as we called it, extra premium. And this is all subject to, this is where modified endowment contract rules and all this sort of stuff come into play. You can only give the insurance company a certain amount of money in total, whether that's required premium and extra premium or excess premium or paid up additions. In aggregate, you can only give them a certain amount of money for a given death benefit.
Yeah, that's a good point to bring up. And we should get into that to point out that there was a time those rules didn't exist.
Right. The glory days.
if we go back, somebody who was born in the 80s, it pains me to say this, 40-ish years, we get to a point where if you come to the realization of what we're talking about today, and you happen to realize that once the money's in the life insurance contract, it enjoys a whole host of tax benefits.
Yep.
You can buy a very small death benefit policy, write a really big check to the insurance company, they'll take it, and now you've got a bunch of money that's growing at a rate that is attempting to accomplish what the insurance company was attempting to accomplish all along, which was grow this big cash balance, and it comes with a boatload of tax benefits.
Yep.
Which was really great. Until somebody at the federal government realized that this was probably not a good idea for long-term tax viability.
This guy paid $1 million in premium for a $100,000 death benefit?
$100,000 death benefit, that would have been impressive. Sometimes they were $10,000 death benefits.
I know. We've seen some pretty wild ones.
In an effort to combat that, we saw some rules get introduced throughout the 80s that stopped just how much money could go into the policy and tied it to the death benefit outstanding at issue.
Right.
And that put limitations on the amount of money that could go into a life insurance contract and benefit from all the things that we're talking about, but it didn't eliminate it. And I want to be clear about that fact because there are some older insurance agents out there who existed in the before times who have developed the opinion that because of those rules that came about in the 80s, life insurance sucks for that purpose now.
Right.
And I don't think that's true at all.
No.
And we've got tens of millions of dollars sitting in life insurance contracts for policyholders who wouldn't agree at all with that statement.
Right.
So there are some limitations.
Don't think they would have done it otherwise.
Right. There are some limitations, but you can still give an insurance company more money than it asks for.
A lot more.
They will take it. Yeah, a lot more. And they will take it and they'll do what they were planning to do with it. Yep. And that's beneficial to you.
Well, and the other benefit is that extra money or the excess or the PUAs is not subjected to the same level of expense that the other premium.
Correct.
That the required premium is.
Yeah. So when you give them this extra money, that's just extra money. Like the money they ask for is encumbered by a certain amount of expense assumptions associated with your policy.
Yep.
But the extra money is not.
Right. Not to say there's no expense, but it's not the same level.
Correct. So that becomes immediate cash. And as immediate cash, benefiting from the same efforts to create rate of return that the insurance company is trying to create from the get-go means it grows faster.
Yep.
So if you want more money in your whole life or universal life insurance policy, maximizing the extra part is a really good pursuit.
I was being smart there.
I know. But I was talking and I only barely heard you.
I said you give them more money. If you want more money, you give them more money. Occasionally we'll get someone who will, this is sort of an inside joke and I guess I'll share. Occasionally we'll get someone who's like, what's the fastest way to get $1 million of cash value in my policy? Give the insurance company something more than $1 million. That's kind of how that works.
It'll work.
No great mystery there.
No. The rules of math still apply.
Yeah. And before some overly zealous smarty pants out there goes, but I thought you said there's no required premium for an index universal life policy. You would be correct, sir. Mm-hmm. There isn't one. When we say required premium in air quotes, which always works well on a podcast, in terms of an IUL policy, what we really mean is enough premium to cover the expense.
Correct.
Which has several components to it, but I'll just call it the expense.
Yes, because functionally universal life insurance doesn't have any set premium. It just has expenses that are going to be deducted from the policy. And so you can pay those expenses with premiums that you pay. But if you don't, it'll just be deducted from the cash value in the universal life policy.
Yep.
That's how that works.
Mm-hmm.
Now, I want to bring up something else that's a cool benefit of all of this. So if we go back to the early inception of what basically was whole life insurance. So we got to go back a century plus. we get the advent of this idea that insurance companies could produce insurance contracts that guaranteed death benefits for a long period of time, but they'd have to ask more money for that. And because they were asking for more money than they necessarily needed to cover the probability of you dying right then and there, they had excess cash on hand because they're building this cash cushion for later. And that pile of cash represents a possibility of growing value, which in the very, very beginning, a lot of insurance companies looked at as money for them.
Yes.
But thanks to the state of Massachusetts, and then eventually the other 49 states as they came along and decided to adopt the same idea, the decision was, no. If you're going to collect additional cash from an insured, you're going to have to share in the equity that creates.
Right.
And thus we have what's called the standard non-forfeiture law, which mandates that when an insurance company collects more money from you than it needs for the explicit pursuit of providing you with a death benefit right now, it must share the value that is created from that activity so that we get extra premium, we invest it, we turn it into more dollars. We are obligated to share that with the policyholder as part of the contractual feature. I want to be clear in pointing out that has absolutely nothing to do with participating policies. So I don't want there to be confusion about the fact that dividends being paid on whole life contracts is a totally separate concept to standard non-forfeiture law. So dividends is just a bonus. It's extra. Hooray. They're obligated to pay us a certain amount of profits as dividends. Standard non-forfeiture law says if they're going to ask for more money from the beginning, they're obligated to make part of the value that is created from that available to you, the policyholder.
Right.
So let's think about this. We give them more money than they absolutely need to provide a death benefit right now today, which means they guarantee that we'll have a death benefit for our entire life, provided that we're willing to fulfill our obligations to the contract, which is pay the premium.
Right.
But they'll take those dollars and they'll invest it to grow the money, which we benefit from. In addition, we can give them more money than they asked for, and they'll do the same thing with all that money too.
Yep.
And then on top of that, if it's a participating policy, we'll get dividends. This doesn't sound so bad. I don't know why the internet like the internet is.
Well, because the internet believes that dividends just come from you overpaying premium.
Yeah, well, there's that. There is that. Which, technically, the definition of a dividend for a life insurance contract is it is a refund of premium that was paid to them.
Yeah.
That is how it is technically classified.
Yep.
But functionally, that has a lot of tax benefit to the insurance company.
I was about to say, yeah.
In addition to the policyholder.
Yes.
So the claim that all they're doing is refunding premium that they were paid means that the dividends that are paid to policyholders are not taxable in the same way that a dividend paid by a public corporation would be.
Yeah. That's kind of like believing the accelerated depreciation in a piece of real estate is a real thing. You know what I'm saying? Like,
yes,
everyone who's a real estate person loves that part of it.
Yep.
Has some significant tax advantages, but you're telling me it actually depreciates that way?
No. We're just benefiting from it.
Yep.
So for the insurance company, the ability to declare a dividend means they declare a dividend which gets paid to policyholders, but there is no income tax incurred on that amount of profit for them.
Right.
It's a deduction to them. And then, of course, you can collect the dividend, and there's several options you have that would then keep that payment also income tax free.
Sure.
So we can call it a refund of premium and get all pissy about that to the degree that we want to. But the real truth is it's got some serious tax benefits behind it, and that's why it's classified the way it is.
Right.
So the trick ultimately in all of this is to maximize the discretionary part, the extra part of what we're giving the insurance company, which is what you and I have been doing every single day for the last
13 years
together, but individually 20,
many more years
25
than that.
Years.
Yeah.
Correct. So that's what it's all about.
Yes.
is capitalizing on this fact that, one, insurance companies are in pursuit of this, and two, they're pretty good asset managers at what they do because they have pretty impressive scale.
Mm-hmm.
Like if you think about smaller insurance companies, there's still several $1 billion assets managed,
Right.
which is a pretty big pot of money.
Yes.
Which means they have a pretty substantial amount of leverage when it comes to the various investment activity they pursue.
Yes. Absolutely true.
Which is why I always roll my eyes.
Particularly with the risk profile that they do it. I mean, that's always the caveat that we put on there. I'm not saying they're going to make you the greatest rate of return ever. That's not true. It's not a hedge fund.
Nope. But when the risk of loss is zero,
right,
then the upside standing at what, year over year, something in the neighborhood of 5% for whole life insurance, probably somewhere closer to 6% for the most part with index universal life insurance. That's a pretty good result.
Yep. Very good.
It's actually a very good result.
Yeah.
And I've always rolled my eyes at the investment types who will say things like, well, they buy bonds, so why don't you just buy bonds yourself? And two things. One, if you're going to buy bonds directly yourself as a retail investor, good luck. And two, you don't have anywhere near the amount of leverage that an institutional investor would.
Sure.
To purchase these things at the terms that would be super agreeable and get them what they're able to accomplish and make returns happen for you. Scale is a thing. It's a real thing.
Yes. 100%.
So the risk profile is...
You can watch your values fluctuate up and down and all over the place. Guess what they don't do when your money's in their life insurance contract?
Move up and down.
No.
Moves up.
Yep.
That's it. So the risk profile is fantastic.
Yep.
When it comes to a rate of return, relatively speaking.
Mm-hmm. To the level of safety.
Mm-hmm. And I think we did this one all the service it needed earlier than most of them.
Oh my gosh. We don't have anything else to talk about? Come on.
It's okay.
No,
that's
it's
talk
great.
So you don't have to talk anymore.
And the one thing we will add here, because I was thinking of it earlier and didn't want to interrupt you. People will talk about, the fact that it's very expensive in relation to the amount of cash value. And we've done this exercise with dozens, I would say, of clients over the years to show them that even with a whole life product, which isn't explicit, you can't see the expenses explicitly. But you can measure it by dollars in versus cash value available.
Okay.
And what we see, and obviously we're not talking about the first few years, there's acquisition cost involved, of course. But long term, these things are not expensive.
No, I mean, expense is such a weird thing to talk about in the sense that, like, you buy a whole life policy and you've had it for 15 years and you've got a year over year rate of return of, let's say, 4.5%.
Mm-hmm.
And you have this position of cash that you have access to. Yep. You do anything you want with it.
Mm-hmm.
It doesn't have any kind of age restriction on accessing the money. It doesn't create any tax liability if you do.
Yep.
You don't have to worry about, is now a good time because the market's doing this, that, or the other thing. It never matters with whole life insurance or index universal life insurance for that matter. So you've got incredible optionality. You've got a solid rate of return, especially when there's no risk of loss year over year. I don't get what the expense part is.
Right. And in index universal life insurance, it's easily measurable because you have it all there. We were just looking at one recently, and how far out did we go? It was 30 years out.
Okay.
If you looked at the expense relative to the cash value, it was like 0.25%.
Yeah. Oh yeah. Yeah.
If you looked at it as an asset management fee, in this particular instance, it was like costing them 0.25% a year.
So think about that. 0.25%
and that's
per
not
year,
uncommon.
which is
We've seen that. So it's almost the same every time we look at it in multiple different scenarios.
Yep.
Not immediately. I'm talking years out.
Yeah. Well, think about that. So 0.25% as the expense of your assets managed, which is a fee most people would kill for when it comes to managed money.
Sure.
That's a fee that's difficult to get in a number of funds you would go out and buy yourself directly.
Right.
Not possible, but it's quite low.
Yep.
And you get all the things that life insurance brings to the table, plus you get a death benefit.
Yeah. Yes. You might have $1 million in cash value and your death benefit's $1.5 million. So if you die, your beneficiary gets $1.5 million.
Mm-hmm.
So it's a pretty decent amount of leverage there. And if you don't die, you've got $1 million.
Yep.
That you can do whatever you want to with.
I guess the only thing is people get a little crazy about the fact that year 1, 2, 3, you don't have a positive return.
Yeah.
There's a lot of assets you could buy where that would be true.
Yeah, I would say most.
There's a lot of investments I've made where that happened. Not by plan, but it happened.
Even when you didn't intend it to, that happened, right? Yes.
So
absolutely true.
It's silly to make a big deal out of that. And, we've been doing this a while. And as I mentioned earlier, there's a lot of cash value now in policies that we manage.
I don't even know what the number is, to be honest with you. I started thinking about it when you said tens of billions. I'm like, is it more than that now? I don't know. Probably.
Well, we totaled it up like a year ago, and we actually did a podcast about it. And back then it was 40-ish million.
Okay.
So it's higher than that now.
Yeah, for sure.
And that is a testament.
Yeah.
To one, the fact that it works, and two, people's agreeableness to it.
Yeah, I mean, the proof is I don't think the people we've worked with would continue to pay the premiums if it didn't work.
No.
They would give up
and
be like, oh, well, this was a bad idea.
Mm-hmm.
I don't hear those complaints.
No, and even with a very few select situations where things have not gone quite as planned, they still made money.
Yeah.
They still accumulated.
Yeah.
And there are aspects to even those policies that are good.
Mm-hmm.
And in most cases, worth holding on to.
Yes.
So.
As evidenced by the fact that those people are holding on to them.
They still exist. Yes. Yes.
Exactly.
Okay.
All right. Okay, now we're done.
I said we were done, and you turned me into a liar, but that's okay. We got a little extra life out of this one.
There you go. What time for one more ad spot?
One more ad spot?
I'm kidding.
Should we talk about another podcast? We can. If you are just listening to us thinking, gee, wouldn't it be great if at least one of them had something else where I could hear them talk even more? You can check out the Yield to Reason podcast. Check it out at wherever you enjoy consuming your podcast.
Find our podcasts.
There you go.
Is there an episode yet? Is there one upcoming?
There is.
Oh, okay.
There is. Now you just gave it away. Which one's going to be the one they have to listen to?
They got to listen to all of them. All right.
And with that, I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.